Today, I want to talk about a moment that many investors, creditors, and board members eventually face. It's that moment when something in a company changes. Management becomes quiet, the numbers stop making sense, and the conversations start sounding like this. Can we meet? About what? Well, we'll talk about it when I see you. If you've been around long enough, you know what that means. Something's wrong. At that moment, when leadership stops communicating, that moment I call the control threshold. It's the point where stakeholders must decide whether they are still observers or whether it's time to regain control before value disappears. True story. A few years ago, we were investors in a gaming company. At first, everything looked promising. We raised capital, intellectual property, the IP was there, team was assembled, momentum was building. It looked like a solid investment. But then something changed. Once the capital was secured and the company had everything it needed to execute, leadership went quiet. Sales projections that were supposed to be extraordinary never appeared. Communication became vague. Things like, let's meet. We'll talk when I see you. So we stayed patient. We tried to help. We arranged additional financing. We even co-signed on a note for them to give them additional runway and better terms. But the company did not improve. It collapsed. The leadership team actually blamed the investors, and the company defaulted on everything in sight. Looking back, the painful lesson was simple. The first time leadership went silent, that was the moment we should have taken control. If I had pulled the plug then, it would have saved millions of dollars. But let me ask you something. Can anyone listening to this here identify with that type of situation? Maybe involving someone you know very well? How big is this problem? Well, situations like this aren't rare. 80% of distressed debt restructurings default in 3 years, meaning attempts to buy time just delay losses. In another period, 113 companies with $100 million in assets filed for bankruptcy, which is far above historical averages. And research consistently shows that delayed intervention dramatically reduces recovery outcomes. But the statistics don't capture the real problem, because for the stakeholders, the damage is personal. Holding on to hope, or worse yet, ignoring the problem, makes things worse. And the damage isn't always limited to the capital that you've invested. Situations like this can injure you in ways far beyond the dollars. Your reputation, your relationships, sometimes even your legal exposure. Believe me, I've seen it, and I've lived it. Let me give you an example of what happens when the right intervention occurs before it's too late. We were brought into a company that had been around for more than 20 years, hardworking people, real business, but the cap structure had become completely broken. Governance was non-existent, chaotic, and leadership had no roadmap forward. So we rebuilt the capital structure, we cleaned up the governance, made the company capable of surviving institutional due diligence. When that work was finished, we had an enterprise that had value exceeding $100 million. And after additional capital and a strategic merger, the company eventually became a NASDAQ-traded enterprise with a market cap of more than $2 billion. That trajectory was impossible until the structural problems were fixed. And that's why I always tell stakeholders something important. The most expensive mistake isn't hiring the wrong guy, hiring the wrong advisor. The most expensive mistake is waiting, and waiting too long. The 3 moves that stop value loss when a company reaches the control threshold, there are basically 3 moves that matter. Number 1, know the battlefield. Before you take action, you must understand the situation completely. As Sun Tzu would say, victorious warriors win first and then go to war, while defeated warriors go to war first and then seek to win. That means you need to understand who actually holds authority. Where is the cap structure broken? What obligations are already in default? And where your leverage truly sits. Without that clarity, investors confront the problem incorrectly and lose control. Step 2, establish control. Once the terrain is understood, authority must be restored. That can involve executing legal judgments, filing receivership actions, replacing leadership, or stabilizing governance. The goal here isn't punishment, it's stability. Because once leadership silence begins, value starts leaking every day. The third step is reclaiming value. Once the company is stabilized, the final step becomes clear. There are only two honest outcomes. Launch the company forward again, or liquidate assets in a structured way that maximizes your recovery. Avoiding that decision is what destroys value. Restoring control means the correct path is visible, and you need to take it. Let me give you three quick examples. One is a public company that had run out of money, missed its SEC filings, and was facing a delisting. What we did, we stabilized compliance, recapitalized the company, and preserved the listing. It went back from the living dead back to an operating and viable business. Another case involved a heavily regulated private enterprise. A receivership was executed, and the company was liquidated in an orderly process. Creditors, employees, and tax authorities were paid. In another case, management threw their hands up and ultimately surrendered. So we recapitalized the business and executed a strategic business combination. Creditors were repaid 100%. Even equity holders, some dating from the 1980s, received multiples on their investment. Now, sometimes you can't turn chicken salad back into a chicken, but those are exactly the situations we step into. When things look bleak, when leadership stalls and stakeholders don't know what to do next, we bring fresh insight and practical strategies. This is what we do. The real risk? No action is still an action, and usually it's the worst one. Waiting doesn't reduce your risk. Waiting multiplies your risk. So if you're facing a situation where management has gone silent, the numbers don't make sense anymore, well, I can create something specifically for you. It's called the control threshold. It explains the 3 moves stakeholders use to stop value loss within the next 30 days. And it shows when informal pressure has failed, when authority must be asserted before leverage disappears. After reviewing the control threshold, the next step for many stakeholders is an independent control assessment. This is a confidential review where we examine, first of all, what is happening behind the scenes and behind the silence. We examine where the authority truly sits and what options you may have that you haven't been shown yet. The goal is simple: clarity and transparency, and real options, ideas that come from somebody who has worked inside these situations, not from theory. The stakeholders who act early preserve their value. The ones who wait are the ones often left explaining the losses. Once creditors, regulators, or courts take control, your influence may be already gone. Waiting rarely improves distress situations. It simply narrows the path forward. If you are dealing with a company right now where the story isn't adding up anymore, schedule an independent control assessment and we will determine what options you actually have.